Yeah, I'm following Mr. MRD speech how to set it.
Ah, so you just go to your indicators and you look it up. Huh? It's not that
Yes, smart concept. Yeah, I also heard it.
you also what?
I was heard it, but the other thing is like internal order block. What? Where you put 50, we put five. I follow. I have to follow it.
The settings must be on the YouTube page.
Yeah.
Yeah, you can follow the input values.
Okay.
I think Bonk is still playing out.
Yeah, I put 2%.
This one just shot through to the sky. All right. Good morning, members. You're welcome here today. Today we are just going to have a simple question and answer. So feel free to raise any question concerning any of the sessions we've been having or any of the challenges you're facing, and you will be attended to. And probably we'll have a simple overview of of simple overview of the fundamentals, the holding fundamentals at the moment. So yeah, you're welcome. Feel free to unmute and ask your question. Speaking to you is Wheezy. You can call me Wheezy, and I'll be facilitating today's session.
So I have a question here.
Yep.
On future trading, how to put a stop loss. I go to the button close, and then I press, and then where I written of trigger price.
Uh-huh.
Uh,
So on your futures account, if you can
mm,
scroll on your screen, can you see my phone?
yes,
You can see my phone?
yeah, I'm seeing.
Okay, so let me see. I don't know if they have a running trade. Don't seem to have a running trade, but do that. Okay, just a moment. Let me set a simple trade so I can show you that. Okay. This what I'm going to show you is going to be from running trade, just like this on your futures. It's the same thing for spot. You're going to come and tap the sell button, and then your button, you're going to enter right here the trigger price, the price that you want to set your stop loss at. Yeah. So
Okay.
let's say the average price here 11100. Yeah. A price below the current price. Whichever the price that you want to set this stop loss, because usually it will be provided or you'll be able to see it on your trading. Okay. So if I wanted to sell at the current price is 1213. So if let's say my stop loss is 1100, I'm basically going to do that. And then I'll tap 100. So when I tap 100, I'm literally instructing the bot to sell my entire position at this price. So what happens is, if the market reaches that price, it is even going to show you the estimated sell profit. Now, because this is a loss, it is going to show it in negative red. So it will show you how much you will be losing if you sold at that price. However, usually when we set a stop loss, it is essentially because we want to limit the money that we would lose and keep the rest. So that is very essential in futures trading. Might not be okay, it's applicable, but you might not really get to use it so much in sport. But in futures, given that as much in sport, because in sport I can hold my coin for as long. So in futures, the risk of liquidation can be reduced, or the risk of really getting into huge losses can be reduced. This is how you're going to set that. You're going to enter your price here, and then you have to remember to tap the 100%, because when you tap 25, it is literally going to sell 25% of your position. So that is what it means down here. So you make sure you tap 100% so that it closes you out entirely on that position. So it is going to calculate for you your estimated sell profit, which is in this case a loss, and then you confirm. Now, when you tap confirm, it is going to place that sell order here. That sell order is going to be treated in the market or on your exchange as a limit order. Limit orders are orders that we place in the market, and then we wait for the market to get to that price for them to be executed. So yeah, that is the sell order. It will keep running, and if the market reaches this level, that is the current price, goes down to this level, it will automatically close your position, and that will act as your stop loss. So yeah, that is how you set your stop loss. It is, I used an example here from sport, but it is the same. The interface is the same for futures.
Okay. Thank you very much. I understood very well.
No.
Yeah.
Okay. For the members who have just joined, good morning, good afternoon, and good evening from wherever you're tuning in from. Thank you for coming through this morning. Today we're not going to share something very, very new, just your questions. So if you have any questions, just go ahead and pose your questions, and we'll be able to answer them. And then I'm going to share some brief fundamental outlook on what we can expect fundamentally in the crypto space. I've taken a long while before coming here, but I hope you understand. And all right, sorry, I had an interruption here. So as I wait for your questions, guys, just go ahead. If you have a question, you can't put up your hand. You can probably type it in the chat, or you can unmute and ask.
I have a question. Good morning.
Good morning.
What is the difference between fair value gap and then an imbalance?
That's a very good question. Thank you, Daniel. I am going to give you the difference. I'm going to give you the difference. Let's see, where can we use as an example? That's a very good question. So there is actually not that big of a difference. Not that big of a difference between a fair value gap and an imbalance. However, one thing is you need to understand is that in trading terms, what we call an imbalance is basically an area that has not yet been visited by price. That is, when price moves aggressively through a certain range and it does not visit that area, again, it is basically called a price imbalance. Let me say it this way. The market is a battle between buyers and sellers, bulls and bears. Yeah. Now, price should move in such a way whereby it favors both sides of the market. That is both the buyers and both the sellers. I'm going to take an example here. Yeah. So you see from this box that I've highlighted here, we're going to look at this price action happening here. Okay, so what do we see here? What we see, the market came in, went up, came down, went up, came down, went up, came down. So what literally is happening here is in the market, there are always buyers at that same time, and there are always sellers at the same time. And both of them place orders in the exchanges or in the order books, whichever exchange they are trading from. So the market to be fair, what we call a fair market is when the market serves both sides of the of the orders, that is the buyers and the sellers, both participate equally in the market, and the winners can control the direction of the price. But regardless of if the price is, for example, moving upwards, for example, now you can look at this price. This price is moving downwards. You see that? It's creating lower lows and lower highs, lower lows and lower highs. But this market is fair. Do you know why? Because both the buyers and the sellers are participating. As the sellers sell, the buyers buy. The sellers sell, the buyers buy. So that is basically what we want to see of a fair market. A market that fulfills both the orders of the buyers and the sellers. Okay. Now, when we have, what was the question? It was fair value gap and what? Imbalance, yes. What we call an imbalance in the market is when the price favors one part or one side. That is, for example, if the price favors the buyers only, that is an imbalance. That means there are certain orders that have been left in the market that have to be filled to create the market balance. You get it? For example, I can show you here. When you look at the move here, when we look at the move happening here, here, let us identify something. In this area, I'm going to just draw a box there. In this area, the market favored buyers. Okay, let us color it orange. So in this area, the market favored buyers. You can see the aggressive push in price rising. Okay, we don't have any sell orders in this region. We just have buy orders, and the sellers were not favored. Okay, so this one, what was created here, is called a price imbalance or market imbalance. Why? Because one side of the orders in the market was favored over the other side of the orders in the market. Now, such price imbalances happen even at a tinier level. For example, this one here. You see that? The one that is down here. It is a price imbalance. It is tiny there. You get it? The market is favoring buyers more than the sellers. Why? Because we don't see any sell orders in this space of this green candle. Just like you don't see any sell orders in the push. We don't see any wicks, anything like sell orders happening in this price. And the price put up on this candle, zoom in a little bit. So when we look at this candle, this one here,